Welcome. You're watching The Big Question. I'm Tamanna Inamdar. With just days to go for the union budget, all eyes are on Finance Minister Nirmala Sitharaman and the announcements that she may make. Now, the union budget is something that we look forward to every year. It's a much-awaited economic event, impact on business, consumers, markets, and the economy. But this time round, the budget is a sign that everyone is watching very carefully. A sign that tells us that India is prepared for a challenge on the economic front. The fact is that we have been seeing a slowdown in high-frequency economic indicators. There is an uncertain global environment right now. We don't know what's going to happen with a tariff war, which will potentially take place. As Finance Minister Nirmala Sitharaman prepares to present the budget on the 1st of February, the air is thick with anticipation as to how the budget can act as a booster for the Indian economy that is currently navigating choppy waters. It comes amidst concerns about a possible economic slowdown stemming from lower than expected Q2 GDP numbers. Remember, the GDP growth in the last quarter, that's the second quarter, hit a 7-quarter low, and forecasts have been revised downwards. This budget suddenly becomes much more crucial in a sense of, obviously, one budget is not going to change the economy overnight or shake things up. But do we have a plan? This is what will be seen. Adding to the concerns, the Reserve Bank of India has also lowered its GDP growth forecast for FY25 to 6.6%, down from the earlier estimate of 7.2%. So quite a sharp drop there. The first advanced estimates of the GDP have also estimated the FY25 growth to slow to a 4-year low of 6.4%. Now, that is as far as the GDP is concerned. But let's look at other factors that we need to watch closely. Private consumption is showing signs of a strain, especially in urban areas. Listen to any of the FMCG companies that have posted their quarterly numbers in Q3, and they're talking about that pain very, very clearly. They're saying urban consumption, more than even rural, needs a boost. Companies are now selling more and more mini packs of their products in a bid to offset price hikes, which the FMCG sector has been forced to take because there has been a spike in prices of raw materials like palm oil as well. In fact, we have reported a fresh 2 to 4% price hike in the offing for FMCG products already. However, it's not all doom and gloom. While a slowdown is being witnessed in urban areas, rural demand has continued to grow. In some segments, you're hearing that. It's the same story with automakers, where the rural sector seems to have come to the rescue. All in all, I suppose the big question that we need to address today, and we have two excellent speakers with us to put all of that in context for you, is what can the budget do to boost the economy? What are those signs that we need to hear? To speak on this, I'm joined by D.K. Joshi, Chief Economist at CRISIL, and Pankaj Tibrewal, Founder and CIO at Ikigai Asset Managers. Welcome to both of you, and thank you so much for speaking with us. I'm going to speak to Dr. Joshi first and start with the economic question. Just let's start at the basics. I've put a few numbers out there, sir, but your assessment of the economy right now.
Well, I think in the last 2-3 years, we were used to positive surprises. The revisions in GDP were always upwards. I think this is the first year in the last 3 years that we got GDP much lower than what was expected. And we also don't see much upside to this 6.4% that is projected. So that is one. But do remember that this is a pretty fast rate of growth, I think, in the global context. And the context becomes very critical at this juncture, because if you want to push your growth up, I think then you will have to depend more on domestic levers. And budget is one of the critical levers there. Global environment will provide shocks and surprises for which you require resilience, I think, and resilience in terms of enough foreign exchange reserves, enough current account deficit within control. I think all those things become very, very important at this juncture. So I think to cut the chase, I think what the budget is going to do, it becomes very critical from the point of view of how much support it can give to growth. And here, I think we can talk about investment, we can talk about consumption, maybe some tax breaks. But beyond that, I think we also need to do some strategic things that ensure that the economy remains on the high growth path for a longer period of time. Don't forget that I think whenever there is trouble, it's also a time to do reforms, etc. And I think India during 1991 pushed its biggest reforms, I think, when there was trouble. So I think this is again an opportunity to do something which will.
But Mr. Joshi, what is the nature of trouble? So is this a base effect? All the post-COVID expansion now slowing down? Is there an inherent issue? Are these global issues? If I were to ask you very, very simply, what really is ailing the economy right now?
Well, I think, see, last year was above trend rate of growth of 8.2%. That couldn't be sustained. I think that is beyond our potential. And we also got interest rate hikes. And we also saw fiscal deficit as a percentage of GDP come down, which means the fiscal impulse to growth also reduced. Interest rates also are contractionary in the sense they reduce the GDP growth. So clearly, economy was expected to slow down, I think, and we were expecting around 6.8% GDP growth for this fiscal. Some were expecting higher. Now, I think the issue is that why did it slow down faster than expected? And here, I think some of the reasons are transitory in nature. I think the very long election process, I think that led to reduced investment. So fiscal deficit was anyway expected to come down, and the capital expenditure were reasonably budgeted. But I think even meeting those would be a challenge. So clearly, a slowdown in government spending, particularly Capex, was behind, I think, the sudden sharp slowdown in GDP growth that you got in second quarter. In the second half, you will see some movement up. Now, the other thing that you were also alluding to is the consumption side of the story. I think if I take you back to 23-24, rural wasn't doing well, urban was doing well. Now it is just the reverse, I think. So the urban is not is the one that requires support. And here, I think for urban economy, apart from other factors, I think the interest rates also become important because they bite the urban economy more than the rural economy because we have higher credit penetration in urban areas. So I think so. These are some of the reasons why I think we saw growth slowing down, and I think beyond this, what happens in the global economy, what kind of budget we get, when do interest rates start coming down? I think all these things, all these factors will shape up the speed of the recovery in the coming fiscal year.
Okay, so one factor is the Capex. So simply put, government spends less. That also could be because, remember, we have a target of hitting 4.5% of fiscal deficit. Maybe part of that equation. Government spends less liquidity flowing into the economy. Economy does see that pain point. Other point is, of course, a consumption pain. Pankaj Tibrewal, and I'm so glad that you're joining us on the big question, because we try and go a little razor focus on some of these issues. Markets have been showing pain. Some of that might be factors beyond the economy as well. But in your view, is this something that we will have to deal with for the next few quarters? And then how does the role of the budget come in?
So, Tamanna, if you look at a few things on the expectation side, one, clearly, we expect that the finance minister should continue the fiscal prudence glide path which she has been talking about, but not get obsessed too much by it. I think if you look at mathematically, if you are at 16 lakh crores of absolute fiscal deficit and economy grows at about 9 to 10%, ideally your mathematics of 4.5, 4.6 will come. So not too much of stress, and this will be a lesser consolidation this time compared to previous year. And all credit to the government that from 9.1 post-COVID, we are bringing it down to 4.5 by next year. But at some point, we need to have a focus on growth, which has been slowed down considerably. And on the back of the fact that private sector is not catching up to the pace one would have expected. So in that limelight, in that fact, government needs to do the heavy lifting. So that brings you to my second point on the Capex side. So if you look at the breakup of the Capex, our sense is a lot of Capex announced last year had low multiplier impact. For example, 66,000 crores out of the 11.5 lakh crores was earmarked to DAA, Department of Economic Affairs. We don't know why it was done. Second is about 85,000 crores was done as an equity infusion of MTNL and BSNL. That's clubbed in the Capex number. That doesn't have a multiplier impact.
Yeah.
Then about 19,000 crores was parked on the home upgradation, which is Home Ministry upgradation of police. That doesn't have a very large multiplier impact. So if we can rethink in the Capex spend, and India does need a lot of urban infrastructure, which is a state subject today. So if we can develop a model, announce a model where center and states could partner, there's an infinite amount of urban infrastructure we all need. Look at the city of Bombay, Delhi, and many other metros and tier 2, tier 3 cities, which is currently a state subject. Can center support it from a Capex perspective? I think that will be very, very interesting model to watch out. Plus some swap on the housing structure, because housing has a very large multiplier impact as you move ahead. So that's on the Capex side of the government. The third slowdown, which Mr. Joshi also pointed out, is the urban infrastructure. And that is largely to do with the monetary policy side. And I think a lot of heavy lifting on the economy has to be done now on the monetary side. Over the last 2-3 years, we have seen huge fiscal consolidation as well as monetary tightening to the extent that the system is deficit on liquidity to the tune of 3 lakh crores. So I think on the urban side, just one data to know, in our estimate, the total EMI of consumers, which includes housing loan, personal loan, jewelry loan, vehicle loan, everything combined, 4.5 years, 5 years back was about 19 lakh crores, the total EMI burden. That, in our view, this year will be about 40 lakh crores.
Wow.
Though the incomes have not kept pace with that. So the leverage, the household leverage has increased, and hence you have seen urban consumption seeing slowdown. Some part on the interest rates or subvention on that side could bode well for the urban class out there. Rural has started to come back, which is a good news. But I think something on the urban middle class is something which is awaited for a long period. It could be outside the budget also, in terms of reduction in petrol prices, in terms of reduction on interest rates, giving monetary impulse to the economy. I think all those things combined could make sure that the economy comes back on the growth path. It should not be a lost opportunity for us after a long time. The economy on the global context looks to be good, as Mr. Joshi mentioned, but our capacity to grow higher and faster is there, definitely, and government should exploit that. Last but not the least, I think private sector is warming up. They are already in the first gear. Many of them, the larger, corporate India. And from first gear to move them to second and the third gear, I think a concessional Capex, tax rate, which was already there, 15%, maybe at 17, 18%, I don't know what we are hearing about, should be introduced again to encourage private sector investment again. Also, don't tinker with any capital gains right now. You just did it 7-8 months back. So let that settle down. And personal income tax collection has shown robust growth, but largely that has been because of the STT and capital gains. Just to put numbers in perspective, few years back, this number was 18-20,000 crore. Our estimate is capital gains plus STT this year would be in excess of 2.5 lakh crore, which has supported a very strong growth we are seeing on the personal income tax collection. So keep that in mind, and our sense should be that more impulse should be given for growth rather than only focusing on expenditure.
Agreed. Just on the impulse for growth, and I want to come down to one simple point that you made, Mr. Tibrewal, which is on household debt. And I think we should take a second and pause on that number. If household debt, which is the sum of all loans people are taking now, it could be buy now, pay later, it could be your credit card, it could be your personal loan, whatever. If you're saying it has doubled in 5 years, ballooned in this extent, how much of a concern is that sitting in our economy right now when growth, salaries, jobs, incomes are not boosting? What is the sort of red flag you see there?
So it's a quite a bit of a red flag, and that's why you are seeing that first instance of that being reflected in the MFI loan segment.
Yeah.
you saw the numbers being declared by all the players who are exposed to that segment, and the scene is not very great because every borrower has borrowed from 3 or 4 lenders, and that's clearly resulting in default. And these are short cycle loans, so immediately as a lender, you need to write off. So our sense is that absolutely liquidity, one, is tight, and second, the household leverage has increased over the last 5, 6 years. Along with that, higher interest rates is clearly putting pressure on the household incomes and disposable income, I would say, and that's clearly resulting in urban consumption slowing down materially. So I think it's a concern where monetary impulse is very much needed, and some kind of a new tax bracket which could give some money in the hands of middle class could be appreciated. But it's a red flag from an economic perspective, and we need to find a solution for that.
Is there scope for it, though? Let me take that question to Mr. Joshi. Is there scope for it? I mean, we keep saying this. I think if I just copy-paste what we all said last year or the last budget, the last 5 years, this, tax boost, put money in the hands of people, consumption booster keeps coming. I just want to understand, is there fiscal space for this from a finance minister's perspective?
Well, fiscal space is not too much because don't forget you are bound to reduce or you have committed to reducing fiscal deficit as a percentage of GDP to 4.5%. Maybe I think you may do a couple of basis point higher than that. But this government has been fiscally conservative and they have stuck to what they have committed. So that reduces the fiscal space. So that you have to spend very prudently, I think, in that case. And here, I think the income tax, maybe there will be some change in the bracket, etc. But that's not going to be a major booster. I think don't forget that I think there are other things also which are playing out. Very high food inflation, both in urban and rural areas. It's got 46% weight in the consumption basket, so it eats into the discretionary spending power of the households. I think that also needs to be brought down. So there are multiple things that we need to do, and here I think promoting consumption via schemes that generate employment and also create assets like Awas Yojana, etc. I think they are more prudent way of promoting growth and also giving a indirect boost to consumption. I think those are the things where you need to focus on. So I think you have a limited kitty. I think whatever you have, I think spend it on as Mr. Tibrewal was saying, high multiplier areas. I think which is essentially infrastructure. I think infrastructure has the highest multiplier. And then second, I think for redistributive purposes, introduce schemes which create jobs and also create assets at the same time.
Fair schemes. In terms of the expenditure on that, directly, indirectly, yes, some of those subsidy schemes are coming via states, but whether it's for political reasons or the need of the hour in the kind of economy we are, Mr. Joshi, how do you look at the subsidy bill ballooning and its impact in the economy?
Well, subsidy bill is a transitory way of supporting the economy. I think the long-term sustainable increase in consumption growth, let's say, only comes when your incomes rise and when your employment opportunities improve. I think that is so. This is the bloating subsidy bill is not such a great thing. Actually, we have brought down a number of subsidies in the past. I mean, for instance, petroleum subsidies, etc., are almost nil. I think close to nil in the last 1 or 2 years. So, but I think there is another part which is rising. So I would say that I think we need to be a little circumspect on this. I think and if it bloats too much, I think it's going to increase your in a way committed expenditure, because subsidies are not very easy to pull back.
No, I'm saying near impossible to pull back, just like taxes. Taxes you can pull back more easily, but no one wants to. No government ever wants to do that. Mr. Tibrewal, what is the single most, I would say, important step that can be taken, in your view, right now to shore up the Indian economy, even as external threats become more and more unpredictable, right? Just on Feb 1st, you will probably see the announcement of tariffs on Mexico and Canada from the United States. We just don't know what's happening on that front yet. What is the single most important thing?
So, Tamanna, clearly we are living in a volatile world, and with Trump coming in, we don't know what the policies will move towards. So, export is a question mark. What government needs to do is that do the heavy lifting as it did in COVID. Maybe at the expense of a couple of basis points, maybe a few basis points on fiscal deficit. Don't get too obsessed by it at the moment, because if the growth momentum gets lost, I think it will be very difficult to revive it back. That's the first. And second, I think we have not been up to the mark on the non-tax revenue side, and especially the disinvestment. So I was looking at the numbers of the last 5 years. We have been able to do only 22% of our disinvestment targets, which I think in a buoyant market like the one which we saw over the last 4 years has not been a good one. There are 66 CPSEs listed in India, market cap about 37 lakh crores. Can we generate a bit of that from the non-tax side and support the Capex, which has a higher multiplier effect, or try to give some boost to the urban consumption so that that also has a higher multiplier effect. So I think both the things combined, along with the monetary policy impulse, making liquidity back to neutral territory, making sure interest rates at some point of time starts to come down and the transmission happens in the actual, I think both have to work together to make sure that the growth resumes back again. Otherwise, if the momentum is lost, to revive that back will be a big challenge in my view, because already you are seeing that in the last 3 to 4 months, the entire narrative from India shining has gone away. So clearly, I think markets are taking cognizance. Corporate earnings growth is anemic, 4-5% of the top 500 companies in India, which is not a great news from an overall economic standpoint.
Okay. Mr. Tibrewal, you said that let's not tinker with capital gains tax, let it settle. But I think most people who are investors in the market are saying that, we might not have to pay capital gains because people haven't made money in the markets. Having said that, on a lighter side, some incentive which you would hope from an equity perspective, equity markets perspective?
See, finally, stocks are slave of earnings, Tamanna. Over longer term, you look at the compounding of Nifty, it's exactly the earnings compounder of 18-19%. And over long term, 14-15%. So I think that if economy is in good shape, corporate earnings growth is happening, we need to not worry about too many smaller things there from a liquidity or other things. I think earnings growth is most important, and earnings growth is dependent on overall economic growth. So I think I would be more focused on growth, that how this government starts to address that now and encourage private sector more to come and invest in India. I think it's a great time when so much of confusion going around globally. We have to market it India from an FDI perspective. Last few years, FDI numbers have been dismal. When you take a net FDI number, it's quite dismal in the sense overall. So we need to make sure that that number starts to increase, and hence investments come back on track. I think that something is the only way you can grow and get rewarded in the equity markets.
Yeah, I mean, everyone loves lower taxes if they are there. But having said that, the interesting thing is that what you're seeing from earnings commentary and in the equity markets is also a reflection of the underlying pain. Perhaps it was being overweighed by global flows, etc. But now that tide has turned, it's all for us to see. Thank you so much, DK Joshi and Pankaj Tibrewal, for joining us on this conversation. Really fabulous. And I hope our viewers have gleaned some insights from it as well. The question we were asking today is, what can the finance minister do to boost the economy? Some great views coming in. But tell us what you think. Tell us what you think of this subject and what you'd like to see on the show. We'll be back tomorrow, same time, same place, with the big question.